Welcome back to Investing Talk Podcast. Today, we're taking a close look at Celsius Holdings. The big question really, is Celsius Holdings a good buy right now? Our goal here is simple. Unpack the sources we've got, articles, research, data, give you a clear, well-rounded picture. It's about cutting through the noise, getting to those important nuggets of knowledge, helping you figure out if Celsius fits your investment strategy. If you find this helpful, please do subscribe, like, and leave us a comment. And hey, if you're feeling generous, maybe consider buying us a coffee. The link's below. Also, is there a specific company you'd like us to look into next? Just pop its name in the comments. We'll definitely check it out. All right, let's get into it. The financials first. We've got a lot of data on Celsius. What's the high-level view? Revenue, earnings? How are they looking?
Well, what jumps out immediately is just the sheer speed of their top-line growth. Celsius reported trailing 12-month revenue of $1.67 billion. That's a pretty big number. And net income was $95.89 million.
Yeah.
But it's that revenue growth that really grabs your attention. It's definitely robust. It seems largely driven by, strong demand for their functional energy drinks, and they're gaining significant market share, both here in the U.S. and increasingly internationally. They're executing that expansion plan.
That revenue growth does sound impressive, but you mentioned the net income, $95.89 million on $1.67 billion revenue. That puts the net profit margin around 5.7%, right?
Yeah, that's right.
What does that tell us? I mean, 5.7%, is that good for a company growing this fast, or is it a bit thin?
Yeah, that's a really critical point. 5.7% net margin is, well, it's somewhat modest for a high-growth beverage company, especially one with this kind of market valuation. It raises that key question: how are they balancing this rapid growth with bottom-line profitability? It strongly suggests they're pouring money back into growth marketing, R&D, distribution, you name it.
Heavy reinvestment.
Exactly. The question is, will that investment lead to higher margins later, or is this maybe just a lower margin business model in this competitive space? But looking at the positive side, their earnings per share last quarter was 33 cents. That handily beat the $21 estimate.
Okay, so an earnings beat, that's good news.
Definitely a positive sign. It suggests those investments are starting to yield results on the bottom line. And looking ahead, the estimate for next quarter's EPS is around 0.26 cents, with revenue expected near $690 million. So growth looks set to continue, even if we keep an eye on those margins.
Right, so super fast revenue growth and earnings beat, but maybe tighter margins than you'd expect. Putting it all together, what's their overall financial health like? Are they managing cash well, or is debt piling up to fuel this expansion?
Well, their market cap is currently around $15.4 billion, and they seem to have a pretty solid balance sheet. They don't pay a dividend, which is honestly total normal for a company in this intense growth phase. It signals they're reinvesting profits.
Plowing it back in.
Exactly. Planting seeds, like you said. Their debt levels look quite manageable. Nothing raising red flags within the beverage sector right now. And importantly, their cash flow seems adequate to support these growth initiatives. For any fast-growing consumer brand like this, you've got to watch working capital and expansion spending very closely. Ensure it's sustainable.
Makes sense.
It's a balancing act, ambition versus prudence. So far, it looks like they're managing okay.
Okay, so financially, they seem geared for growth. But this energy drink market is brutal. How are they actually doing against the giants? Monster, Red Bull, are they making a dent?
Oh, they're definitely making a dent. Celsius is really emerging as a leading challenger. They're going right up against Monster and Red Bull. They've strengthened their position a lot through product innovation, things like their functional powders, amino formulations, stuff that targets that health-conscious consumer.
Their niche.
Precisely. And beyond the product, their distribution gains have been huge, just getting onto more shelves and more places. But maybe their biggest edge is that brand resonance. Celsius connects really well with health-focused folks, younger demographics. That healthy energy angle, combined with smart marketing, has carved out a loyal following. It's a differentiation that's proving effective.
Okay, that paints a good picture of their competitive standing. Now, the really interesting part for investors, the valuation. We know they're growing fast, competing well, but is the stock cheap, expensive, or priced for perfection? What are the metrics telling us?
Yeah, the valuation metrics are pretty clear. This is a richly valued growth stock, no question. Let's look at the PE ratio.
Price to earnings.
Sitting at 151.39.
Wow, 151.
Yeah, it's very high, especially compared to the sector average. It tells you there's enormous future growth already priced into the stock today. The market is definitely betting on continued massive success. Now, the forward PE, looking at expected earnings, is 48.50. Still high, still above the sector, but maybe a bit more reasonable if you believe the growth forecasts.
Still requires a lot of growth to justify it, though.
Absolutely. And the market cap to sales ratio is around 9.2x. Again, a significant premium compared to most beverage peers. So all these metrics are way above industry norms. It reflects huge optimism. But, and this is the key thing, it also means significant execution risk. They are priced for perfection. Any slip-up, any missed target.
Could hit the stock hard, yeah.
Exactly.
So what are the analysts saying? Do their price targets reflect this sky-high valuation, or are they maybe a bit more grounded?
Well, it's interesting. The price targets vary quite a bit. That range itself tells a story. You've got conservative targets, sort of $53 to $68, which from the current price suggests either a bit of a downside or only limited upside in the near term.
So some caution there.
Yes, definitely some caution from certain analysts given where the stock is trading now. But then you have these really optimistic long-term forecasts. Some are calling for targets as high as $287 to $385 within 12 to 15 months.
Oh, that's quite a leap.
It is. And while that's exciting, you really have to treat those outliers with a lot of caution.
Yeah.
There isn't broad consensus on those super high numbers. It's a few analysts making very bold calls.
Understood. Okay, fundamentals and valuation point to a high growth, high expectation story. What about the stock chart itself? What's the technical picture? Is the market trading like it believes this, or are there warning signs?
Good question. The recent price action definitely shows a volatile stock, but the trend has been clearly upward. The current price, around $57.30, is near its 52-week high range of roughly $21 to $60.55. The daily range recently, like $57.89 to $60.55, shows that volatility we mentioned. It moves. Technically speaking, key support seems to be around the $54 to $57 area.
Yeah.
That's where buyers have tended to step in recently. Resistance looks like it's around $60 to $68. That's where selling pressure might increase. Most technical models seem to suggest the price could stay within, say, a $54 to $76 channel over the next few months. Still a wide range.
And what about specific indicators like moving averages or momentum oscillators? Are they bullish, bearish, neutral?
Well, the moving averages look strong. The 50-day is around $45.93. The 200-day is near $34.39. Both are well below the current price, which typically indicates a strong long-term uptrend. That's bullish.
Okay.
The 14-day RSI, the Relative Strength Index, is at 40.52. That's pretty neutral. So it's not screaming overbought and needing a correction, nor is it oversold and signaling a bounce. It's just neutral from that momentum perspective.
Interesting.
Volatility is still elevated, around 8.32%. So expect continued swings. Overall, the technical trend is bullish, but given how high it's climbed, short-term pullbacks or consolidation wouldn't be surprising at all. It's had a huge run.
It really has. So charts confirm the strong trend, but maybe hint at needing a breather. Shifting to, let's say, the market buzz, what's the latest news? Any upcoming events that could really be catalysts for the stock?
Well, the big recent news was that earnings beat we talked about. That's always positive for sentiment. And generally, the stock carries a strong buy rating among analysts. But as we noted, those near-term price targets are often clustered closer to the current price, some even suggesting a limited upside or slight downside.
So the rating is strong, but the immediate price expectations are maybe more muted for some.
Exactly. Sentiment on social media seems broadly bullish, but with a definite undercurrent of caution. It kind of mirrors the wider market indecision, perhaps. The Fear and Greed Index is at 39 right now, which points to lingering fear in the market overall, even with those bullish analyst ratings on Celsius specifically.
A bit of a disconnect.
A little bit.
Yeah.
And interestingly, our sources didn't mention any notable recent insider buying or selling. That can sometimes be a signal, but here it's more of a non-event.
Okay, so a mixed sentiment picture. What potential catalysts should investors really be watching? Things that could genuinely move the needle for Celsius, short-term or long-term.
Short-term. The big one is definitely the next earnings report. That's scheduled for August 7th, 2025. That will almost certainly drive volatility.
Earnings are always key for growth stocks.
Absolutely. Beyond that, new product launches, new flavors, new lines are always important. Expanded distribution deals, getting into new retailers or regions, those are key near-term drivers. And, there's always the potential for analysts to upgrade their ratings or targets if the company keeps delivering strong quarters.
Right. And longer term.
Longer term, it's really about sustained international expansion. There's still a huge global market out there for them. New strategic partnerships could be significant. Think alliances that open up new channels or customer bases. And then there's always the M&A angle, mergers and acquisitions. Could Celsius be a takeover target for a bigger player? Or could they acquire smaller brands themselves?
Interesting possibilities.
Definitely. And underpinning all of this is that broader trend towards health and wellness beverages. That's a powerful tailwind that should continue to benefit them long term.
Okay, makes sense. But no investment is risk-free. What are the major roadblocks or risks investors need to consider with Celsius? What could derail this growth story?
That's the crucial question, isn't it? What could go wrong?
Mhm.
On the company's specific side, the big one is execution risk. They have to keep delivering on these very ambitious growth targets. That high valuation, being priced for perfection, means any stumble, any earnings miss, even just slower growth than expected, could trigger a sharp sell-off.
High stakes.
Very high stakes.
Uh.
Also, that aggressive expansion, while good, could strain resources if not managed perfectly. Supply chain, marketing costs, inventory. It all needs careful handling. Then you have the broader market and sector risks. Competition is fierce and increasing. Monster, Red Bull, even Pepsi and Coke are getting more into functional beverages. They won't just cede market share easily.
Right, the giants fight back.
Exactly. And the consumer discretionary sector itself tends to be more volatile than others. Yeah. Bigger swings are just part of the territory. Finally, there's regulatory risk. Potential changes around energy drink ingredients, health claims, marketing rules. That could always impact the business. It's something they constantly have to navigate.
Okay, that's a very balanced view of the potential downside. So we've covered a lot. Fundamentals, valuation, technicals, news, catalysts, risks. Let's try to bring it all together. What's the final takeaway? Is Celsius Holdings a buy now? How should someone approach it?
Yeah, pulling it all together, the overall rating from the sources we looked at comes out to about a 7 out of 10. The reasoning is pretty straightforward. You have very strong top-line growth and a solid competitive brand that supports long-term optimism. However, that's balanced by the really high valuation and a degree of analyst caution about the near-term upside from current levels.
It's a good company, maybe expensive stock.
That's a fair summary. It trades at a premium because of those growth prospects, but that makes it vulnerable to corrections if execution falters or market sentiment sours. The analyst targets for the next year suggest caution is warranted, even though the long-term story, driven by those wellness trends and their brand, still looks positive. So for short-term trading, it looks pretty risky. There might be moderate upside, but within a volatile range. Probably not ideal for momentum plays right now, unless a clear new catalyst pops up.
More for experienced traders, maybe.
Probably. But for long-term investment, it becomes, I think, more attractive. If, and it's a big if, Celsius can keep up that revenue growth, defend or improve margins, and continue winning market share over several years. For investors with that longer horizon and a higher tolerance for risk, maybe buying on dips could offer better entry points, reducing that valuation risk somewhat.
Makes sense. So, in summary, Celsius is a high beta, high growth stock. It's got strong fundamentals, but trades at a steep valuation, tempered by some near-term caution. It seems most suitable for risk-tolerant, long-term investors banking on continued growth, but who understand it could be a bumpy ride.
That was a really thorough look at Celsius Holdings, and as you, our listeners, can tell, really understanding a company for investment goes way beyond just a headline or a single number. It involves digging into the financials, understanding the competitive landscape, gauging market sentiment, and crucially, weighing that exciting growth potential against the risks and the price you're asked to pay. So after hearing all of this, what stands out most to you? How do you weigh that impressive growth story against the high valuation and those execution risks we talked about? Definitely keep those questions in mind as you navigate your own investment decisions. Thanks so much for tuning in to Investing Talk Podcast, and we'll be back soon to explore another set of sources on a different company.